You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. And we're off and racing. Hello.
We are back. Welcome in, everyone. And,
What's up?
What's up? You know what?
The internet.
This is the first time we've had different equipment doing our podcast.
You've stopped copying me.
Yeah, that's basically what's happened. Yeah, I became my own man.
I thought I was a role model to you.
Yeah, you were for a while there.
Not anymore.
Nah.
Damn it, my ego. Down it goes.
Yes, I've got a new microphone. You got a new camera.
Yeah.
And a new lens.
So I'm going to look like 10 times crispier than Hamish right now.
Yeah, pretty much.
So I have to just keep the camera on me the whole time.
Yeah, well, that's fine with me. And I'm editing it, so...
Yeah, sure. No. What a stitch up. Yeah. Now it's going to be completely on me the whole time.
You just go to watch it and it's just you.
It's just me.
Yeah. I mean, we could put both cameras just on you if we want.
If we want. I mean, you get this side of my face, get that side of my face. That'd be quite nice.
Yeah.
Maybe we should do that.
Yeah, I think we should.
I don't know. Yeah. No. Definitely not.
All right.
We're talking about stuff today. We're doing a podcast. Here we go.
we're gonna actually.
This is so funny with us. Like, we were just saying before, when we're just on Skype or on the phone, it's like pretty professional. We like keep a good structure, and then whenever we're in person, it's just like everything just goes.
Yeah.
So it's just like complete banter for an hour.
Pretty much, yeah. I mean, the last one we did in Sydney. We were just talking about YouTube for
we
almost the entire time.
It probably wasn't the best podcast for people that want to learn about stock market.
It wasn't really related to investing at all.
No,
but,
it was just us having a yarn. Yeah, and I remember last time you had your mic around the wrong way.
I do too.
Remember that? We've solved that issue. You can now look that Hamish's microphone is...
I got an idiot-proof microphone.
Yeah, idiot-proof. Doesn't matter which way that microphone's facing.
No, that was frustrating. Because that room was already pretty echoey, so...
It was and at the time, we just thought that was the echo.
Yeah, we were like, oh...
Yeah. Because there's for people that don't know, we were both using this microphone at that time, and there's a blue light on the front face, because the front face and the back face look the same on these microphones. There's a blue light on the front, and then I realized about halfway through editing that podcast that I could see Hamish's blue light on his microphone.
Terrible.
And if I could see that, he's got it around the wrong way. Anyway,
yeah.
Lesson learned.
Yeah, lesson learned.
Yeah, we got a couple of comments on the audio that time.
I don't know if I read any of the comments on that. I don't read comments that much anymore.
Yeah.
I can't say... Do you still read YouTube?
Oh, like I see them, but...
Yeah, I see them. I don't respond to a lot, and I turn off notifications now on my phone.
Yeah.
I can't do it.
I like to read through it. Like, it's good to get a gauge what people are thinking.
Yeah.
But I think I just don't... Like, when I was in the... I had a couple of thousand subscribers, then I would like watch every comment, like read it. Am I doing this right or not? But now you just like the power of numbers. You just got to accept that there's some good comments and some really bad comments.
That's why I can't read them, because like if you say one bad comment, it kind of ruins your day. Yeah. Sometimes.
And then if you see bad comments, then you're like, I have to make my content try and cater to everyone. Yeah. And then you kind of lose your unique voice, and then your content becomes just mush.
Definitely.
Like you've got no backbone anymore, because you're just trying to please everyone.
Exactly. And you certainly don't want to change your content for the 1 out of 10 if the 9 out of 10 are enjoying it.
Yeah, if you're getting 9 comments to say, hey, this was a helpful video, and then one says that, Hamish, you look stupid.
You're ugly.
Yeah, you're ugly.
I hate you.
Yeah. Do you have any off the top of your head that you can remember that are just like absolutely bonkers?
Yeah, I get a lot, because when I wear like a t-shirt instead of wearing a button-up shirt, I get that one a lot. People will be like, wear it. I'm not listening. Or where I'm wearing like a hoodie or something. Yeah. People will just be like, why are you wearing a hoodie? I'm not going to listen to you. I'm like, okay.
I have to find the story here, because I think I took a screenshot maybe. There was one which like, it was the most bizarre comment. It was like, you are an albino ghost. You have no complexion whatsoever. I was like, is this trying to like be a negative comment? I don't even know, because it's like there wasn't swearing or anything. It's just like with these really obscure things to bring up. I don't know.
Yeah, I remember you sent me that, and it real weird. Yeah.
Yeah, it was odd.
Not your average comment.
But we should probably move on anyway.
Yeah, because
there's so much to talk about today. Because,
there is.
Man, things just keep getting worse in the markets.
Yeah, I mean, what was it last night? Another 6% down.
6% off. Yesterday in the ASX was another 6-7%. We're recording this on Thursday. Is it Thursday today?
Yeah, it is
Thursday the 19th.
Yeah.
Thursday the 19th.
Yeah, and
of
what,
March.
Monday night, overnight in the US was 10%?
Yeah, 10%.
11%, something like that?
Big declines. Yeah, big declines.
Yeah, and what? It's been 3 weeks now of declines. 4 weeks maybe. 3.
Yeah. And it seems like... one thing that I've been hearing from people is they say, oh yeah, but it comes down and it just bounces straight back up to where it was, because they see like one day it will go down 7% and then another day it will go up 7%.
Yeah, but
that's I got to always remember, if this is you, remember that if you go down 7% and then up 7%, you don't end up back in the same place.
Yeah, like down 50 and then up 100 is back to even.
Yeah.
So
down
50, then a gain of 100. So it's it's interesting.
It's interesting. Don't forget that. Yeah, the market's definitely tanking at the moment.
Yeah. So what are we at now? We must be close to 34-35% down, probably for the S&P 500.
You were saying that
let's have a look.
The last 2 years of gains now have been eroded completely.
Yeah. So I had a look back, and it was January 8 or something, 2018.
Right.
Which is where the market was at this level last time. So, it's 2 years of stock market gains erased. I think it's worse for the Dow Jones, but I'm not entirely sure.
Yeah, it's certainly it's certainly tanking. There's negative stories anyway. However, positive story out of all of this, Tom Hanks has been discharged from hospital. Yes,
it's back in action. Has that been 2 weeks since he got? I
don't know. No, it's been like just over a week since he got put in quarantine.
Right, okay.
Yeah.
He's a free man.
He's a free man. That's the one thing I saw when I saw everyone getting corona, and then I was just like, oh man, this is crazy. And you saw like, what is it, Peter Dutton, and then Ivanka Trump's going into isolation. I was like, whatever. Yeah, but then I saw Tom Hanks. I was like, no, you can't get Tom Hanks.
Yeah, not him.
No, but he's good.
Yeah,
thank goodness.
He's back in action. How's Dutton going? Is he?
I don't know. I don't know, and I don't care. I do not care.
I saw some interesting comments. Someone was like, I didn't know a virus could get a virus. That's quality. Not saying I agree or disagree, but that's a quality joke.
We're like PewDiePie or like Q News. Oh. we don't give our opinion.
Yeah, no opinions here.
This is completely factual.
We give our opinions and then say they're not opinions. Okay.
Yeah, but Peter Dutton's an arsehole.
Yeah.
But that's not my opinion.
Anyway. Oh dear. What else have we got? We've got.
I don't know.
So I'm in Australia. It's kind of sort of picking up a little bit, because I know that obviously Italy's still in complete lockdown.
Yeah.
The US is kind of...
It's like 30,000 cases.
Yeah.
I think, or something.
It's crazy because it's such a small country as well. And they have such a... It's
spread like wildfire.
Yeah. I don't know how that's happened, but like the US restaurant bars are banned, I think. And
they're really closing up shop over there.
Yeah.
I think they're just trying to nip it in the bud.
Yeah, definitely. It's probably a smart move, I think. Like, you've just got to...
You just have to.
You just have to
cop it.
Because,
I guess they probably look at this from multiple angles, and they're like, well, what... Is it better if we just take a hit and lock everything down right now before it gets bad? Or is it worse... Maybe even if you don't think about just the health and safety part of it, where obviously you want to lock it down quickly. But even if you just look at the economic impact, is it better if we just go, nah, we're shutting things down right now to stop the spread? Or do we kind of have these half-baked kind of social isolation rules, and then it slowly spreads and it just drags on for longer and longer?
Yeah.
Is that a better economic scenario? It's probably better that you just... Like, I don't know the answer.
Yeah, I don't know either.
But yeah, it seems like they're definitely just trying to go, okay, just lock everything down, social isolation or whatever, and then just try
get it over and done with.
Yeah,
I mean, having a complete lockdown is certainly hurting some businesses more than others. I mean, if you think of things such as like the entertainment industry, for example, all concerts and like the football. What do they drop it down to 17 rounds or 18 rounds?
Yeah, 17 now. Yeah.
Are they playing today? Did they?
Yeah, no, they are.
They are. They decided.
They're going to play round one. Yep, just no crowd.
Restaurants. You can imagine there's probably a lot of independent restaurant owners who have leases, have a bit of debt maybe, and they might not be able to afford.
It's a tough gig.
Yeah, it is tough, but yeah. I mean, health has to come first over economics.
Oh, definitely.
If it's
definitely.
I think there's no question about that.
Yeah.
That's.
I mean, you can even think about that at a personal level. Would you rather have money or health? It's like, well, if you don't have health, then you're going to die before you can use your money. So
can't have money if you're dead.
Yeah, exactly right. It's just that whole notion of richest man in the cemetery.
Yeah, exactly.
It's like, cool, you got the biggest tombstone.
Yeah.
It's like, who cares? You're dead.
Big tombstones are cool though. Okay.
They are cool, but you don't get to experience the coolness.
Maybe you do. Maybe you just rise out. And
Yeah. Okay. Right. Okay. Harry Potter shit right here.
No, but so Australia's banned gatherings of more than 100 people now.
Wow,
which is
Jeez.
Yeah.
There you go.
That's
not that many people really.
It's not.
Like I'd run like body pump classes to maybe 40 odd people.
Right.
So maybe double that in a bit. And it's not actually that many people, 100.
No, it's not.
Yeah. So that's crazy.
That would surely mean most bars and most clubs.
Oh, definitely.
Would be.
Yeah, probably definitely.
Would have to close
even
doors.
popular restaurants.
Yeah.
That could sit more than 100 people.
True.
There you go. Yeah, it's pretty crazy. We're supposed to be implementing, what is it called? Social distancing. Yeah.
1.5 meters. We've got our.
Yeah, I was going to make a joke, ask you, what are some tips on social distancing from the guy that was doing it before it was cool?
That's good. That's awesome. You get so many people so easily.
Yeah.
Yeah. No, it's actually true though, because like, I mean, we both work from home.
Yeah, that's true actually.
So for a significant part of our lives at the moment, we're
social distancing.
We're
being responsible.
Exactly. I just knew this was going to happen. So.
Yeah.
I was just prepared.
As soon as I heard the word coronavirus, I thought, better social distance myself. We've been doing it ever since. 72 days in now.
Yeah. 21 years in.
21 years later.
Oh, dear.
But yeah, it's pretty crazy. Australia locking the place down. Similar around the world, I guess. The US is locking down. Italy's really locked down. And I think the interesting thing, which is obviously making the markets tank so much, is just like, who knows how long it's going to go for. I mean, all of the medical experts are saying it's going to get worse before it gets better. It's like, all right, if it's going to get worse and we're already doing what we're doing, it's like, geez, how long does this go for?
Yeah, and I mean, that's the thing is like, if the medical experts are saying it's going to go for a long time now, maybe that's why the market has tanked so sharply in anticipation of that.
Maybe. So it'd be interesting. So it's like baking the future into the market.
Yeah, exactly. Like expectations. And then if that was to change over the next couple of months, there could be a sharp increase in the market. And if it doesn't change, it might continue to go down. It's obviously highly unpredictable, but it's interesting to think about.
And was it a couple of days ago that the US Fed, they came out and they said that they were dropping rates to zero?
Yes. So that was on Sunday.
So we're seeing lots of like the Australian, we had that stimulus package announcement or whatever, and there's a lot of kind of government or central bank steps that are being put in place now to try and cushion the fall. So what's going on with the Fed?
Yeah, I mean, they're obviously very concerned. Yeah, so on Sunday, Sunday night, the Fed dropped interest rates to 0%.
Zero.
So
okay.
I think previously, so they have a range, so it's technically 0 to 0.25, so it's slightly above.
Yeah.
But it's 0. And that was a 1% drop. So typically they do 0.25% drops, so 1% is pretty significant when they make that kind of drop. And they also announced that they're starting quantitative easing again, which will be fun. So that's what they did. That's what they did during the GFC. To sort of kickstart.
So what's this? This is like QE QE4, I think.
QE4, yeah.
QE4.
So, yeah.
And I was actually, because to be honest, not having studied economics or anything, I didn't really understand the nitty gritty of quantitative easing and how it worked.
Yeah.
But from what I can understand, it's what they actually do, the Fed, like buying treasuries and that sort of stuff. It's actually similar to what they would just do normally, like if they're cutting rates and that sort of stuff. The difference and the reason that it's given a name is mainly just due to the scale. So it's just done on a much bigger scale, I suppose.
Yeah.
But yeah, I found that interesting, is that, yeah, like quantitative easing is just like essentially just printing money to buy those the government treasuries
and mortgage-backed securities in some circumstances.
Yeah, it was mortgage-backed securities in the GFC, wasn't it? That was that big bailout. They bought a lot of, and then I found that interesting because I really didn't really understand how it works and how that like increases the Fed's balance sheet, because they've bought financial assets, and then over time they try and it's kind of like the Fed is kind of like this weird like buffering system where they kind of just they step in to kind of make the line.
Yeah, they try and smooth the edges a bit.
Smooth out the edges. So it's like they step in when times are bad to try and, buy the financial assets and boost the economy, and then when times are good, they try and sell back those financial assets and take the money back and then turn it into nothing again.
Yeah, and I mean it's weird because they try to offload some of their balance sheet for about 6 months, and they crash the stock markets. They immediately turn. So really, we've had 10 years where, following that theory, they should have been off. Like the last 5 years should have been slowly, offloading. But I mean, they stopped quantitative easing, but they weren't able to, go into quantitative tightening or whatever they call it, the opposite, where they're offloading the balance sheet.
Well, I guess they were cutting rates as well, and part of the cutting the rates is buying the treasuries as well, isn't it?
True. Yes. Yeah. Exactly.
So that just adds to their assets on their balance sheet, I guess.
Yeah. Yeah. So
I really need to study this more. I find this really interesting.
Yeah, definitely. Yeah, I mean, when they tried to raise interest rates, that would be them selling treasury bonds to the market. And they couldn't do it for very long. Yeah. They did it was late 2018. They did it for about 3 months or something. And
it's pretty crazy. So they buy, so they make, they print money, they use that money to buy these treasuries off of the banks, so that the banks can offload the treasuries and basically swap them for straight cash.
Yeah.
So the banks have higher liquidity.
Yeah.
So the idea is that the banks then sit there and say, look, we've got all this cash now.
Yeah.
Our cash isn't making much of a return for us because it's cash. So we try and get that money making more by putting it to use and offering it for people to borrow.
Yeah, loaning it out, making investments for themselves.
And then the idea is that the banks are all doing this at the same time, so they're now competing with each other for people's business, and that usually passes on those savings to consumers. I think that's what I got out of the research that I did.
Yeah, and I mean, and then hasn't worked so far. I mean, like they've been lowering interest rates for not the quantitative easing, but they've been lowering interest rates for a while now. And there really hasn't been any pickup. Generally, when they lower interest rates, there's a pickup in inflation, but there's been nothing. Yeah.
What's that, like stagflation? Is that what it's called?
Stagflation is where...
Or is that different?
No, that's different. Stagflation is where there's a recession and there's high inflation. So that's the case where the central bank needs to decide, do they want to try and lower interest rates further and kickstart the economy, or do they raise interest rates to stop inflation getting out of control? It's basically the worst situation you can be in, because they pretty much have to stop inflation before it gets out of control, and increasing interest rates while you're already in a recession means that it's even makes money even more expensive, investments even more expensive. So
that's probably not a position you want to be in.
Yeah,
interesting. But no, that's super interesting. So that they this new QE program is $700 billion of value.
Right. Yes. So I think on the Monday that they announced it, or they announced it Sunday, but on the Monday they were planning on injecting $40 billion. So it's $700 billion over an extended period of time. Yeah. I guess it's kind of like when a company announces that they updated their buyback program.
It's going to happen over time.
Yeah.
Okay. Yeah. But interesting that there's such a big announcement of of this happening, of interest rates going to zero and QE, and the market just doesn't care. It just keeps dropping, because you'd imagine it would help, right?
Yeah, well, yeah, you would think. I mean,
think so.
Strictly theoretically, you would think it would, but a lot of people are saying that because they did it on the Sunday, it was just stupid, because it was an emergency rate cut. They did it on the night over the weekend, so people had time to like stew about it, to think about it and worry. And
so they should have just done it straight away.
Yeah,
on a like before a trading day or something.
Yeah, or just slowly
do it
done half percentages instead of like it's a big move, so clearly they're very concerned.
They must be. Yeah.
And the market hated it. Futures went to 5%, and then it was halted for permanently. And
down we go.
I was really surprised that they didn't get to 13%. They nearly did that night. I thought they were going to get to the second breaker.
Oh, so, yeah, right. The second halt. Yeah.
So if they're, for those who don't know, if the S&P 500 is down 7%, they halt trading for 15 minutes. Then they open again. If it reaches 13, they halt it again for 15 minutes. And then if it reaches 20%, they halt it for the day. So, yeah.
Imagine if you saw a 20. Man, imagine that. Imagine seeing 20% down in a day.
And that's like the market. So there's some businesses down maybe 40.
Yeah. Because the average.
Yeah, because I mean, what was last night? The market went down 5%, and you had the cruise companies down 25%, which is crazy.
That's unreal. It's just hard to fathom 500 massive companies collectively going down on average 20% in one day.
Yeah.
Like something's going horribly wrong when that's happening. But I don't know, we could see it. It's certainly getting sticky.
It's getting sticky.
It's getting sticky.
Yeah.
Sticky situation.
How are you? Are you investing at the moment? Are you holding back?
Yeah.
Still waiting?
No. I'm not a big believer in holding. Like if you see an opportunity,
take it.
Just take it.
Yeah.
Just take it, because like I just think about it like there's two possibilities, right? We'll just talk about passive investing, just like buying the market. There's two possibilities. The market goes down, as what we've seen. It's gone down heaps, and it's either going to go up from here or it's going to go down from here. If I buy in now and it goes up from here, I'm like, oh yeah, just made money. It's not ideal, but I'm making money. I'll take it. But if it goes lower, then I'm like, oh, cheering. Like, this is just getting better and better. So I think for me, my idea is that classic idea of buy slowly kind of thing. Like if it goes down a bit, if you're a passive investor, that is, just buying the market. If it goes down a bit, buy in a little bit. If it goes down a little bit further, keep buying in. Because for passive investors that are dollar cost averaging, going to hold stocks for 40 years. I mean, now it's just any market decline is just an opportunity.
Yeah.
If you're going to hold on for 40 years. So for me personally, I'm kind of, that's the way I think. What about you? Do you think similarly or differently? Or?
Yeah, I don't do a whole lot of passive investing, so that kind of doesn't sort of cross my mind too much. But in terms of, individual businesses, it's just gone from maybe 6 months ago, there was one business I thought was good value to now maybe it's 4 or 5. So it's just the opportunities have kind of just opened up a little bit. 4 or 5 on your watch list.
On
my watch list, not
total
5. Gee. Watch it.
My microphone, careful.
Not 5 out of the... Well, it is 5 out of the entire market, but it's for me.
For you.
Yeah. Because I have a very limited scope.
There's only 24 hours in a day.
Yeah,
and if you want to understand your businesses.
Yeah,
that's just like the people that I follow 200 companies. It's like, no, you don't.
No.
You don't. You might know generally what the price is of all those 200 companies, but you don't understand 200 companies.
Yeah, you do not.
No. You just wouldn't have the mental capacity. But sorry, did I interrupt the point you were making?
I don't think so. I can't remember what I was.
You're just talking about active investing.
Yeah,
your approach to when the market goes down, you're finding more companies on sale for you.
Yeah, there's been a few more opportunities. I'm still quite a lot in cash.
Me too.
So, I mean, prior to all of this stuff, I was very heavy in cash.
Yeah.
Almost to the point where I was like on the edge of my seat. Like, if this goes on for another 3 months, I'm just going to put some in because...
Yeah. Well, I remember you were telling me, you're like, geez, I have to get some money into the market.
Yeah.
Like, you're saying like, even if you accept a slightly lower rate of return... I mean, it's better over the long run. It's better than just sitting here in cash that's just doing nothing. Like, you want to have that buffer, but there's like a certain amount, like what you was telling me, where it's just like, at the edge, you're like on the edge of your seat, and you're just like, I've got to get some of this money into the market.
Yeah, exactly. Crazy. Yeah, I mean, I'm thinking, okay, if I have 50% in cash plus income coming in, which is going to add to that cash position, it's better for me to just start putting some in, accept maybe a 10% return with a margin of safety instead of 15%.
15, 20, yeah.
But yeah, luckily I wasn't doing too much of that. I think I only made maybe one investment where I was thinking, wow, I wouldn't normally make this investment, but I just have, like, I'm sitting on like 65% cash.
Right. Yeah.
So I have to put something in.
That's correct. I'm in the same boat though.
Yeah.
But no, it's nice.
But it's better now. It's much better. I'm more stocks than cash now.
Oh, great.
For the first time
in a while.
Ever.
Ever, yeah. Well, I mean, we haven't, like, we're only in our I'm in my mid-20s now. You're in your early 20s. So it's like we haven't been investing for that long.
No.
We can't sit back and say, oh, we've been investing for 25 years.
Yeah. And I've been in cash the whole time.
Yeah, basically.
No, but it's very good to get some opportunities.
Yes.
And
come on.
Yeah.
I always struggle, like, talking about these big market crashes and when businesses start struggling, because on one side of the coin, I mean, we've done our research and we're like, no, things have been too expensive, we've held off, now we're getting our chance. So on like one side of the coin, it's just like, yes, like, come on.
Yeah.
And then on the other side, it's just like, I remember in The Big Short when Brad Pitt's character,
yes,
when he was like, had a really concerned face on, and then the two young guys
were
just
happy,
like jumping for joy.
Yeah.
He's like, why aren't you excited? And then he said some quote where it's just like, if unemployment goes up by 0.1%, so many people die in the US or something. So it's just like, it's like, that's the other side of the coin.
It's true.
It gives us opportunities to do what we want to do and invest in companies at cheaper prices.
It's a horrible event. Yeah.
In the grand scheme of things, it's something that maybe you shouldn't jump for joy, people losing jobs and that sort of stuff. But I mean, it seems like it's just so far from what we've seen anyway. Like, there has been some businesses that have been impacted, but it's not like looking at those GFC numbers for unemployment and horrific numbers like that, which is good. Yeah,
I mean, the way I see it is, of course, a recession is just, well, for starters, they're so unpredictable. So it's not as if we know when the terrible circumstances are going to happen.
Yeah.
But if they do happen, they just create opportunities to buy it. Like, I kind of see them completely separate. It's not as if it's not as if I'm cheering on a recession. It's like, recession is terrible, but my assets that I want to buy are cheap, so I'm going to do it.
Yeah.
Like, I'm not going to...
The two sides of the coin are not, like, strictly related to each other. Like, us getting excited to
like
be able to invest, I guess, and people losing their jobs are not strictly related.
I guess the way I was thinking about it is, me buying shares in Facebook stock isn't causing someone to lose their job.
That's true.
So
That's
it's kind of...
It's
very unrelated.
Yeah, but I get what you mean.
Yeah, it's...
I get what you mean.
I hope that this event is a short, sharp event, because that's good for everybody. It's good for investors who were able to pick up those assets well, and it'll reduce the job losses and the other sort of terrible things that come out of this kind of event. Yeah,
the economic downturn lasts for less time. I wanted to talk about this next topic here. Moving on, I wanted to kind of gauge your opinion on this issue that's been going on in the US. There's massive controversy at the moment with the US airliners because they are requesting a $50 billion government bailout.
Wow.
Yeah, so it's massive. And the reason that this is a controversy is that airline stocks are, it's pretty cyclical, right?
Yeah.
You know, in boom times, it's going to be more people traveling and flying. In bad times, it's going to be less people. So,
and not only that, they're very debt heavy, sort of capital intensive businesses. So a lot of them come and go. It's one of those industries where the major airlines have kind of just absorbed all of the airlines that can't survive through recession. So prior to a recession, you see there's all these like weird airlines that you've never heard of. You're like, what the hell is Spider Air? And then 3 months later, it's gone. It's just wiped off the face of the earth. It's just like their planes and stuff have been absorbed by another company, a bigger company.
Yeah. My point here is that if you were running an airline company, you would definitely know that you're going to have strong times in the good economic times and weaker times in the poorer economic times. You would know that because you know that your business is cyclical.
You'd
right?
hope so. Yeah. You hope they have that conversation.
You would hope so.
Meeting. Guys.
Yeah. I think that our airline company is going to go like this forever. It's kind of like back in the tech bubble when all these you just put internet in the name of your company and you can come out to the market and say, look, I think we're going to grow at 100% annually forever.
Yep. Our revenue was 4 cents last week, but we are worth $50 billion.
Yeah, there were literally people, I remember reading about it in some book that in the tech bubble, there were managers, CEOs that were coming out and saying that they think that they're going to grow at 50 to 100% annually indefinitely, like forever. I was like, how can you say that? How can you cannot say that. Anyway, it's like, that's a sign of a dodgy management team. Anyway, I lost my train of thought. I was saying, yes, so you'd hope that the managers of these airline companies would recognize that there's going to be good times for them in the good times, and then they're going to suffer in the bad economic times. So you would probably think, if you were a strong management team, a smart management team, that in the good times, you would use that increased profitability to prepare yourself for the bad times that will inevitably come. That's exactly what Berkshire Hathaway has done, Warren Buffett's company.
Right, yeah.
They've used this amazing last 10 years, and Warren Buffett has gone on record and he says, don't worry about, we've built up this massive cash position. We want to buy businesses with that. We want to buy stocks with that. Well, stocks are businesses, but you get what I mean. But don't worry, Berkshire Hathaway shareholders, we're always going to keep $20 billion on the sideline as an emergency fund.
Yeah.
Smart, really smart. Because if there's a bad economic time, they've got that buffer that they can potentially use.
And I will take, you can shave 0.5% return per year off my return to guarantee that you will never go bankrupt.
You go bankrupt. Yep, I'll take that.
And to be able to sleep well at night.
I'll take that.
Yeah.
The problem here is that these airline companies, instead of bolstering their balance sheets, what they've been caught doing over the last 3, 4, 5 years is they've been doing massive share repurchasing programs, right? So they've been using their excess cash to do this very short-term propping up of earnings and that sort of thing, keeping the shareholders happy by taking as much of their stock off the table as they can. And what that means is that if you're a shareholder and then the company is buying back its own shares, then the more they do that, then the bigger your percentage ownership in that company is going to be. So they've been doing these share repurchase programs instead of bolstering up their balance sheets. And now we've hit this obvious downturn for particularly the airlines where no one's traveling at the moment. They're being hit hard. And instead of the airlines, instead of the airlines having the cushion that they need, they've gone, oopsie, help. Government,
help.
Can we have $50 billion? Can you give us $50 billion? We need to make sure we don't go bankrupt. Remember, we're very important for your economy. So please give us the money and then we'll stay in business and your economic impact won't be as large. And obviously people are just like, guys, this is ridiculous. It's ridiculous because it's their fault that they're where they are. I mean, yes, it's the fault of the coronavirus or whatever, but really, it's their fault.
Yeah.
And now they're just going, doesn't really matter because we know that we're so important to the US economy that we'll just turn to the government and ask for money and we'll probably get a bailout because the government doesn't want us going bankrupt.
Yeah, it's kind of sad because it's probably a small room of maybe 8 people who have made decisions to consistently repurchase stock, and if they were to go bankrupt, which is really what should happen in this circumstance, I think, because they've just been irresponsible.
It's just irresponsible.
It costs the shareholders, but it also costs all of the employees that lose their jobs.
That's true. Yeah.
And particularly if it's an event like we've seen where it's been so sharp that, I think I saw it must have been American Airlines cut back 80% of their international flights. Yeah. Last week or something.
I think they're basically all doing that.
They're almost all just absolutely gutted their flights. It's just been tremendously tremendous. It's kind of a Trump.
Yeah. Pick a different word.
It's just been so sharp. yeah, it's tough because if it's all 4 major airlines in the US that go under, what happens? Does that just kill the economy because
I guess so.
Because no one can fly?
Is this a similar issue to what happened in the GFC with the banks?
Yeah, I think
the banks
is.
knew that they had so much, importance to the economy.
Yeah.
That if shit really got bad, they'd probably get a bailout.
And
that's when they started playing with those really crazy kind of derivative structures.
Yeah.
Is that have I got that right?
Yeah, well, I mean, they just kept pushing it and pushing it and pushing it.
Yeah.
And
more extreme and more extreme.
Yeah, and yeah, I mean, it's that whole too big to fail kind of thing where if you're a certain size, then you have a certain impact.
You have a certain power.
Yeah, exactly. I mean, I don't know how many people have jobs in airline for those 4 airlines, but I'm sure it's probably hundreds of thousands of people. Maybe even more.
You'd imagine so. Yeah. So you reckon that overall your opinion would be let them crash and burn?
I mean, I don't know because $50 billion sounds like a lot, but I think if you compare it to say the bank bailout, I think the bank bailout was in the trillions. I think it was a lot.
Was it like
it was a lot
$3 trillion
because it's a huge industry, whereas the airline industry is quite a lot smaller. So, I mean, yeah, I don't like the idea that a business can get a bailout, and me as if you're a smaller business, just because you don't have as much impact. It's not going to be as destructive if you fail. You don't have that option. I mean, that option is not available to most businesses.
Imagine that. Imagine if this is the situation. Imagine you started up, Hamish's Hardware or something like that. You just sold hammers.
Yeah, tell me more about this awesome business
venture.
Yeah,
it's fantastic. It's basically Bunnings Warehouse, but replace the name with Hamish's Hardware.
I've got an idea, and we can put it right across from all the Bunnings.
That's genius.
And we'll just take all of their customers. Wait, no, that's what Woolworths did.
But imagine you running your business, and I don't know, you make some really irresponsible decisions. You just go expansion for expansion's sake.
I start derivative trading on steel or something.
Something like that. Or you just open like 1 billion stores because, I want to expand my business, but you leave nothing in the bank.
Yeah.
And then, turns out there's some economic downturn. There's new laws saying people can't be gardeners anymore. And your sales go through the floor. And then you turn to the government. Instead of going bankrupt because of your mismanagement,
stupidity,
you can just go to the government and say, hey, excuse me, I'm very sorry to do this, but I kind of need a cool $100 million just to make sure I don't go bankrupt. Oh, no worries, Hamish's Hardware, here you go. It's just imagine if to small business that's never an option. It's like you fail, you're bankrupt.
Yeah.
It just sucks that from the government's perspective, it just comes down to, okay, it's just an economic question. It's just like how much of an economic impact in dollars do we have if we let these companies go bankrupt? And then what's the economic impact if we spend $50 billion and we bail them out and we keep them in business so that people can keep flying to and from the United States?
Yeah.
And whichever one wins is just obviously the one that the government will go from. But that's just a case of the airlines just having so much power.
Yeah. I mean, the problem is that the US government, at least, I don't know about other areas, but now they have a track record of doing this. Because I'm not sure the airlines, maybe they would, but I'm not sure the airlines would be pushing so much buybacks and just be not care at all about
if they thought the risk was greater.
If 10 years ago the banking system collapsed in the US, not that one. It's tough because you can't. If the banking system fails, it just ruins.
Then it ruins people's lives.
Yeah, so you kind of have to make a call there, but it's kind of like the precedent that it's set, and now again means that if you're an industry that has a significant economic impact, because the airlines themselves don't make that much money, but it's all of the industries that are attached to it. I think I saw a figure that corporate travel is globally a $5 trillion industry.
Yeah,
so that's just corporate travel, and then you've got vacations and all of the other kinds of travel. But it's really not just directly the airlines' profits. It's like what the airlines allow. It's kind of like a toll to to different places for all of the other businesses, but.
Yeah, true. It has that flow-on effect of affecting other businesses.
Yeah, I guess in the same way that the banking system does as well.
Same thing.
Yeah. Because not only would it affect the banks, obviously, but everyone who had money in there can no longer spend money in other industries.
Yeah.
Yeah.
Yeah, what should we talk about next?
I think we should do a question.
Oh, you want to do a question? All right.
I want to do one question, then maybe we can jump back some topics.
Yeah, sure.
Because why not?
All right. Do you want to do this first question here?
Yeah, sure.
One up top.
Okay. Do you want me to read it to you?
Sure. Go for
it. Here's a question that you could possibly answer on your next podcast. Here we are. How many ETFs are too many when building a portfolio? Take into account it being a beginner investor who only wants to hold a small percentage in individual stocks. Would 4 to 5 be crazy high or low? Is 15% of portfolio invested in the S&P 500 too low?
Obviously it depends on what you want to do, I think. It depends on what your strategy is. And I can't decide what that is for you. Yeah. But for instance, you're right in I can see where the thinking is. If you buy a lot of ETFs, then you're probably going to get a lot of double up, right? So if you bought, like, for instance, two that track the Australian market are IOZ and VAS. IOZ is the top 200. VAS is the top 300.
Yeah, and if you held the S&P 500 one, for example, and a global one, well, the US market is what, 30% of the global one, or something?
There's going to be a lot of overlap.
Yeah.
So I don't think that there's much point in holding an ETF like IOZ and VAS because the difference is those companies 200 to 300, which it's such a small market cap collectively of the whole Australian market, a small percentage of the whole market that just won't make a difference. So I don't think that there's any reason to have to double up in that instance. But you can understand that maybe some people want some exposure to the broader Australian market. They might buy an Australian market tracking ETF, and they might want some exposure to the US. Yeah. So they might buy an S&P 500, or maybe they don't want exposure to just America. They want to do what you were saying, just the global 100. Or something like that.
And I mean, the global one is mostly the US. It's mostly US and China.
It is, yes.
It's
up
global's a little bit misleading.
Yeah.
It's mostly two economies.
Yeah.
And then there's a couple of
as you go down the list, you'll see, like, I mean, it's really, there's only a few select companies from the other countries. Like from Korea, there's like Japan. From Korea, there's Samsung and like another one I can't think of. It's like Japan, there's like Toyota and a couple of car ones, I think. Yeah, Mitsubishi or something like that. But yeah, you're right. It's mostly Chinese companies or American companies.
Yeah. What do you think about percentage? 15% invested in the S&P. Is that too low? What do you think about that?
I think it depends on what are you trying to do? Right, if you want to be 100% passive, if like this person here said, they want to only hold a small percentage in individual stocks, and the way I take that is they want to be mostly a passive investor, as opposed to an active investor. So, like, I don't know. It comes down to, like, where do you live? We don't even know if this person lives in Australia, or, like, if you lived in the US, I'd be like, well, why are you focusing on Australia? You don't even live here. Like, just focus, like, more on the US. But if you're Australian, then maybe if you are more bullish on the Australian economy, then just bias it more to Australia. If you're more bullish on the American economy, then bias it to America. Personally, I'd be more bullish on the American economy, but that's just me. That's just what I think. Yeah. That's, like, you shouldn't trust that. That's just what I think. But yeah. I mean, so I think percentages just depends on, like, you know, what are you trying to do, and where do you live? What do you know most about? That sort of stuff. Yeah, definitely. Yeah. I mean, I know that. I think that's quite a smart. I think it's a nice sort of strategy to have most of your portfolio in passive investing, just index funds, maybe one index fund or two index funds. And then if you're interested in individual businesses, but you don't have the time or the patience to research and study 5 to 10 businesses, just spend all of your time trying to find one and make it like 5% of your portfolio. Small or something. Position. Yeah, because then you're still diversified. You're just a little bit more exposed to one business. Yep. And you got the experience of analyzing an individual business in depth as opposed to 10 in no depth whatsoever. I mean, that's more or less how I got started. Was I had the Vanguard index fund that was 100% of my portfolio, or most of it, and then I just tried to find one business.
And yeah, I remember my portfolio looked really weird for a long time because there was only one, everything was so expensive. There was only one business that had kind of like, 25% in my portfolio. And then it was mostly index fund and a couple of tiny positions. But yeah, now it's changed a little bit recently.
It's a bit different.
Yeah.
It looks. I made a video on my stock portfolio from like 2-3 years ago. And then I was like, looked at my portfolio now. I was like, that's very different. I don't think I like hold any, like the only investments I still hold are the passive investments. Right, I think basically everything else has been cleaned out. It's like actually learned how to invest.
Yeah, exactly. Yeah. When I was getting started, none of those stocks exist in my portfolio anymore. But I would imagine that the ones I'm holding now will be there for quite a while. Yeah. I would imagine.
No, As this, I'm getting increasingly more happy with how my portfolio looks. with the now that the stocks are coming down, it's just like, oh yeah, like now that I've added that one, like you feel really good about. I'm sure you've probably added some recently, and you look at your portfolio and you're like, yeah,
I've been waiting to see you there.
Yeah. It's like, it's nice to have you guys in my family now. It's nice to meet you. Yeah. It's nice to meet you.
I've been watching you for so long from afar.
I've been watching you. And now I've gotcha.
That's funny.
But no, I hope that answers the question. Let's do another question here. This is a long question, but I did read it before, so maybe I'll just try and shorten it. Essentially, this person asks, they say, in previous videos you've said how you're slow to buy, you prefer to research a company for a very long time, waiting on the sidelines with a good sum of cash for a bear market, waiting until you really properly understand that business that you're looking at. And then they ask, if you may be looking into these businesses now, and you're not 100% across the business yet, but you're seeing this opportunity, or what you believe to be as an opportunity.
Yeah.
Is there a time where you would start investing in a company, even at a small amount, when you're not 100% across it yet? Yeah. Or do you just make the rule that, nope, I won't even look at the price until I know exactly what I'm doing with the company?
Yeah, well, I want to feel confident before I make any investments. That's the first thing. But it's not as if there's a point at which it's kind of like a moment like, aha, now I know enough. It's not as if there's a point like that. It's just that I would be comfortable putting more, like the most I'd probably put in a stock was maybe 20%, maybe 25. Probably that would be the most. But I'd only be confident to put it that high if I had researched it for a very long time. So most businesses will start as maybe like 2 or 3%.
Yep.
And I think that that's something that Warren Buffett, there's been some people that believe Warren Buffett did this a little bit, because he has quite a lot of stocks that are just tiny percentages, but he just buys a little of them so that he has some skin in the game. And then once you've sort of got a little bit of ownership, that might sort of kickstart you to care a little bit more as well, because it's kind of, obviously you do research before you invest in anything, but you care a lot more once your money's invested in it, or at least I find that to be the case.
Yeah.
Definitely. I mean,
your money's on the line. Yeah. You're gonna pay attention to
it. I mean, with Thor Industries, for example, at that position, with like the amount of money that it was in, because I've been investing in that company for 2 years now. So the amount of money that I originally put in is maybe 10% of what the position is now. So over time, I've been much more... Yeah, like I liked it back then, but I wasn't super confident in the valuation. I didn't really know much about the industry when I started investing in it. 2 years later, I feel like I know the industry quite well. I've been through, 8 different reports that have come out. And I've read, the same reports for the other businesses in the same industry. So I have quite a good grasp on what happens over a 2-year period for a business, that you just can't, you can look back at past reports, but it's not the same as when it's happening, and you can see what's happening with the stock price when an event is happening. So I feel like it's just over time you develop more confidence, and you'll be more inclined to put more of your money in that stock. So it's not really a clean answer, because there really isn't.
I agree. It's just like, well, I mean, generally I follow the principle of buying slowly anyway. Yeah. So usually when I first buy into a stock, I'm not investing the whole amount that I would like to.
Definitely.
And I agree with you, though, that investing a little bit in a stock makes you wake up and really pay close attention to it.
Yeah.
Because you got skin in the game.
Yeah.
All
right.
Yeah. And I think that... I forgot what I was going to say there. Yeah, I think that obviously if you're buying into a stock, then it means it's just come down to the price that you like to put in it. So you probably wouldn't dump the whole amount into that time, because if it keeps going down, then you add more and more over time.
Yeah. So I mean, I guess to answer that part of the question, when I do a valuation, I don't have a specific number of how much I'm willing to pay for that business. It's a range. So
yeah, I think intrinsic value should be thought of as a range.
Yeah.
Not a number. I mean, you'd be kidding yourself to think the valuation measures that we use are so precise that you could put it down to, when you get a number like a fair price of $194.27.
Yeah, I'm sure some people kind of think that. No, but yeah, I mean, if the stock price is like $50 per share and you say, okay, intrinsic value is between $0 and $200 per share, you've got probably a 98% chance of being right. So I'm just trying to find a range that is not 0 to 200, but still has a decent chance of me being accurate, that it can fall within that range. So the range might be, well, can they grow at 4% to 8%? There's a significant difference between 4% and 8% over a 10-year period. So when it falls to the price where I'm thinking it can grow at 8%, I will invest a little bit, but I won't be going heavy into that stock.
You're not putting the house on it.
Yeah.
No, I get that.
Yeah.
One question that I wanted to ask, maybe we might finish up with this question depending on how far we've gone. Oh yeah, we'll probably round it out to be about an hour. Maybe. Yeah. So this question is a question that I've been seeing a lot on YouTube at the moment.
Right.
And the question basically reads, do you think it's wise to buy shares of US companies at the moment, given the downward trend we're seeing in the market, and also considering how bad the exchange rate is from Australia at the moment? So some people are saying that maybe you buy an ETF from here in Australia that tracks the US market, so you can still buy it in Australian dollars.
Yeah.
Some people are more focused on individual businesses, and they're just wondering, do you just maybe sitting here in Australia, do we just focus on buying Australian businesses, or do we just have to cop that exchange rate? What are your thoughts on it?
Yeah, I mean, to start with the ETFs, I'm not. I'd be curious to see if that would actually help. Because
I don't think it would, unless it was what we were talking about last week with currency hedged.
Yeah,
ETFs.
You would be relying on the investment fund hedging against the dollar and being right, because you can't just say hedging and just eliminate all your risk. I mean, you're still making bets, right?
Yeah.
So in terms of the ETF thing, I'm not sure. Maybe you can. Maybe we'll find out. We'll find out.
I don't know. It feels bad us running a podcast and be like, I don't know, do your own research.
Yeah.
All right. Next question.
Yeah.
I don't know.
I feel like if you were someone who was on TV in traditional media talking about finance, you just BS your way through any question. Whereas there's a lot of stuff we don't know. No. Because I don't really look at ETFs that much. I invest in Australian ETFs. So, there's a lot of stuff we don't know. But
it takes courage to stand up and say what you don't know.
Yeah, well, yeah.
Instead of you're right. If you saw it on traditional media, they would just be like BSing their way.
They wouldn't. Yeah.
You to pick it up straight away.
Yeah.
It's kind of funny. I forgot what I was going to say just then. I had this point I was going to make. Anyway, it doesn't matter.
I can just continue on anyway.
Keep rambling. Yeah, maybe it'll come to me.
Keep rambling. Yeah. So in terms of individual businesses, certainly if you buy US businesses, you have to convert Australian dollars or whatever currency you have into US dollars, and then back when you want to take that money out. And we were discussing before, the interest rates are interest rate. No, the exchange rate. The exchange rate between the Australian and US dollar is 56 cents, getting close to 50. And if it's 50, if you put $1,000 into US, you get 500. If that goes back to $1, which it's been at in the past, you're turning $1,000 into 500 just through currency. So that would halve your overall return. If you made a 15% return, your return once you converted it back would look more like 7%. So it is significant. But I don't know. Maybe I'm just ignorant, but I am not that worried because I don't need to bring that cash in US dollars back into Australian anytime soon. Like it's going to be something that's for retirement. So I don't know what the exchange rate's going to look like in 3 decades. Maybe it's worse. Maybe it's better.
Right.
Like it's easy to say, well, it used to be $1, and you look over the past 10 years, it kind of bounced between $1 and 50 cents or 60 cents. It's easy to say, oh, well, this is the worst time. But how do you know it's not going to start a new range between 60 and 30 and this is the best time? So like, I think currency is so unpredictable, and I think it's really, you can do hedging with some sort of instruments, but I just hold US dollars and Australian dollars. I just hold a bit of both, and that way I'm not at the mercy of an exchange rate. And I don't know, maybe that's an ignorant answer, but I just don't think currency is something you can control. So I think it's just the nature of the market. Yeah,
I think if you just find businesses that you want to invest in, you just have to invest in them.
Yeah.
And just trust that if you hold them for a long time, that your eventual return over 10, 15, 20 years will outpace whatever the currency could send you backwards by.
Yeah.
I think that's just the way you have to go about it.
And the thing to remember is the exchange rate between the US and Australian dollars is represented by how much money is being pumped into basically the economies. So if more people if the interest rates for US savings accounts are better, then more people are going to be wanting to transfer their money into US dollars and put them in those savings accounts to get a bigger return. So it's just a demand for the currency, which means there's more people holding US currency, and a lot of that is going to be put into stocks, which means you're not going to get the entire effect of currency. It's not as if your $1,000 turns into 500 and there's no impact from that dramatic change on stock prices. It would have an impact because people are moving money into the US. So there's that as well. But it
certainly hurts a little bit still when you're transferring to US dollars.
Yeah,
I can't avoid just that feeling of just being like, oh, I'm getting so little. But you're right. I mean, looking back, you can't. Looking in the rearview mirror is never going to be a way to go.
I mean, currency's down fairly significantly, but US stocks are also down a lot. So even though you're getting less US dollars, you're able to buy US shares at substantially cheaper prices, which is good. Yeah, I just think currency is not something you can predict. If it doesn't have cash flow, then you can't predict it.
You can't predict it. That's exactly right.
Yeah.
All right, should we wrap things up there?
Yes, I think we should. It's closing in on an hour.
That was a good podcast. We were quite snappy. We actually worked through the things we wanted to talk about.
Yeah, we did.
I feel like sometimes we can get a little bit dragged down in some topics.
Definitely, yeah. But, I was surprised. And I mean, it's always fun doing these in-person ones. It's so much more it's awesome. Comfortable, I think.
Yeah. It just flows. I don't think you have to edit too much out of this one.
No, not at all.
It would just pretty easy to flow. It just, again, it reminds me, I think I said this in the last podcast we do, but it's just amazing how much of our communication is physical, like being able to get those physical cues of when someone's finishing a sentence. Like you can get those verbal cues, like you can hear when someone's decided that they're finishing a sentence.
Yeah.
But it's like better if you can see. It just makes things so much easier when you can actually see the emotion in each other. So no, we hope to do it eventually in person, like all the time. That'd be awesome.
That would be very good.
We're going to need a lot of Sharesight subscriptions to be able to fund that. Which brings us to our sponsor. You thought that we weren't going to fit it in. But I proved you wrong. Yeah. Today's sponsor is, of course, Sharesight. What's the link that we have to go to?
Sharesight.com/young investors. We can put it on screen, I guess.
We can put it on the screen.
Well, if you're listening on Spotify, we can't put it on screen.
No, we can't.
That's Sharesight, spelled SHARESIGHT. .com/YOUNGINVESTORS. Bang. That's it. Sign
up.
For
clarification, that was
HTTPS.
What is it? :// or something? Oh, I don't even know.
Oh, dear.
But what's the deal? You sign up with that and you get 2 months free when you sign up for a 1 year subscription.
Yes, so you can get a completely free plan, try it out for as long as you want. There's no trial. Like you don't have to stop after 30 days or 7 days. Just try it for as long as you want. Check it out. Why would you not do that?
Yeah.
You'd be silly not to do that.
You would be silly.
But then if you do want to sign up for a paid subscription, you can get 2 months free when you sign up for a yearly subscription. But make sure you use our link so that we can get a studio and do in-person.
That would be nice.
In-person podcasts all the time.
That would be nice.
So it's on you, all right? It's not on us.
It's on us. You. The success of this podcast depends on you.
We're not getting a government bailout.
There's no Oh dear. What's this? Australian government announces new podcast help package scheme. That'd be fantastic. Podcasts are really hard to make money off of. Really hard. That's one thing I've noticed just doing them. I feel sorry for the people. Like YouTube is one of the best platforms for monetization.
Oh yeah,
definitely. Yeah. Instagrammers, there's no inbuilt system for monetization, but you can still monetize it through brand deals or whatever. Yeah, advertising and whatnot. But podcasting, that's hard. It's hard to monetize. There's no all-in-one system which places ads on your video on your podcast. So we always try and look to companies that are interested in sponsoring, and it helps us make these podcasts every week. So if you want to check out Sharesight, just go and do it. And that's it. That's it. Bye.